So here we are starting with the CMA US part 2 revision session. And at first we get started with section A, which is financial statement analysis. So let me just tell you the structure of this particular session. First, we'll be going through the overview of this particular topic, which is financial statement analysis. While going through the topic, I'll be explaining the complete context of it, the concept also of it, and where you are going to use it, and what type of questions you can expect in the examination. And soon after that, we will be doing few MCQ questions related to that particular topic so that you get an understanding of this overview of this particular section. I'm talking about this complete section. I'm going to teach it from the Gleim material. If you are using any other material, just follow it by the sections. Like section A is financial statement analysis. For now, whichever material you're using, follow it with financial statement analysis, and I'll be getting started with it. I'll be just sharing my screen in a bit, and we get started. And I also have my notepad, means OneNote running in at the side, so that whenever there are some things which I need to write it down to explain it to you, I'll be doing that too. Now understand this, we are not going to go in detail of every topic or every word. What we are going to go is an overview so that you guys understand it. It's a brief explanation. Why? Because this is a quick revision for you for your examination, because you are going to give your examination sometime soon. So this is going to be highly helpful for you. All right. So let's get started. In financial statement analysis, we have three chapters. We have three chapters as per the Gleim material. You can see liquidity, solvency, leverage ratios, profitability, per share ratios, activity ratios, and special ratios. So without further ado, let's just jump into that what exactly we are going to do in here. So first we have this common size financial statements. Okay. Now common size financial statements, what we do, why do we actually make it? See, when we are having these type of common size financial statements, we take one amount as a base. Like suppose if it is an income statement, we take sales as a base, take sales as 100%. And if sales is 100%, what about the remaining amounts? At what percentage are they denoting it? So that's what we'll be doing with financial statement, common size financial statements. So what we do in here is that we take in 2 to 3 organizations. Now, when we have these 2 to 3 organizations, I suppose the sales of this organization is compared to another organization, what all are the percentages of the other amounts we compare of this organization to the other organization, so that the investor who is doing the analysis of this particular statement, or the person who is going to advise them on financial investment, they are analyzing these financial statements so that they understand that which organization should they invest, which organization is more profitable, which can give you more amount of return, that organization you can go ahead for. So in this particular section, this complete section, we are going to do this only. We are going to analyze the organization, whether this organization is profitable, investable or not. See, profitable, investable, we do not have to give them statements what's happening in there. But what we can do is nothing but according to this ratio, like suppose if we do a current asset ratios kind of a stuff, according to the current ratio, which was there previous year, has improved in this year. From previous year, you have improved to this year. You are not giving an advice directly. You are just telling it current ratio is better when compared to the previous year. The receivable days are better when compared to the previous year. The payable days are not good when compared towards the previous year. So this type of things we are going to tell. We are not going to give them a final statement whether to invest or not. We are just doing analysis of financial statements. So if you just see in here, why we do it with percentages is because we can have proper comparability like this, if with how it is given in here. Anyhow, we'll be doing the MCQ sessions. That time we'll be going through the problems, and that's by the end of this particular session you will be able to go through it. For now, just understand this, that what it is. Like net sales, they have taken it as 100%, and then whatever is that amount, we just divide it by that and get a percentage of it. Like suppose this 1.650 is your 1.65 million is your cost of goods sold. So what do we do in here is nothing but just take that amount. Okay, we take that amount and say it as if this is going to be your, according to that percentage. Like suppose 1650000 divided by 1.8 million. How much do we get? it's given in there 91.7%. So likewise, what we do is nothing but we make a complete statement of how much percentage it is, and we calculate it accordingly. With the income statement, we do it, and also we do it with the balance sheet. So here you're not preparing any financial statement. What you're doing is nothing but understanding that how can we compare these financial statements. We are taking out their percentages. And why do we do so is nothing but to understand that what's going on in the organization, to make analysis of that particular organization, that how well it is doing. In fact, what you can do is nothing but go towards Google, find out the financial statements, annual statement reports of any organization. Most of the organizations, it will be available over Google. You can download it, look into their financial statements, look into previous two financial statements, have an analysis of it, compare it with another organization. That also you can do it. In fact, this job is done by those financial analysts in the market. If you qualify as a CMA, one of the jobs which you can do is do this analysis. So you don't need to always do it manually with a pen paper. It can be easily be done with the use of Excel. Okay, so vertical and horizontal analysis, understand this, it's just going on in this way. External reporting format, if you just see in horizontal format, that what is the current year here, what was the previous year, what was second pre-year year, matlab 2 years ago, what was 1 year ago, what was 2 years ago. You are just having an analysis in that particular format. That's horizontal. And the previous one was vertical, the one which we just did. This is a vertical analysis, and here comes your horizontal analysis. Now coming up towards the main part of this particular chapter, which is liquidity analysis, liquidity ratio. Now what we are finding out is nothing but in this particular liquidity ratios is that how good is an organization in terms of cash in hand, or in terms of how much liquid they are, if they are going to have any such expenditure coming up, that how much in hand they are having to spend. That's the main concern with liquidity ratios. Now how is that going to be? Let's just see in here liquidity ratios. It's current assets by current liabilities. Always remember this. I've been teaching this since I guess 10 years now. While I was studying also, that time also I was teaching few of my friends around. Remember this. Liquidity ratios is current ratio, your quick ratio, your quick ratio or asset test ratio, or then comes your cash ratio, cash and convertibles to cash within like this, and that's convertible in that. So there are a few things which you need to understand this. See, this balance sheet they have taken up for the example of this complete chapter itself. In fact, for the next 2 chapters also, this type of balance sheet only will be the example. So if you're watching this particular session, you can pause it, understand, okay, this is what the balance sheet is. In fact, you can even put down some analysis on this. Okay, so here there are going to be a lot of ratios, formulas. In fact, one of the easiest topics in CMA part 2, in fact, is this chapter. Okay, so now we also have the income statement for the example. This is the illustration, or this is the dump data through which you are going to calculate all the formulas which are going to come in ahead, and that's related towards the liquidity. So for the liquidity, first what will be coming in here, see, current assets minus current liabilities is your net working capital, and current assets divided by current liabilities is your current ratio. Your current ratio means how much you're having. See, most probably, most of the times, if your current assets, if current assets is 1 or more than 1, okay, if it is more 1 point something else, it means that it is a good ratio. Understand this. This is an analysis which you need to do. See, if my current ratio is 100,000 and my current liabilities is 90,000, so my answer is more than 1. Why? Because your current assets are more than your current liabilities. In fact, it is ideal also that your current assets should be more than your current liability. That's how an organization will be good enough. And if suppose, how is the trend going on? Is it increasing? Is your current ratio increasing, or is it decreasing? Is your net working capital increasing, or is it decreasing? That's what you need to see. If it is increasing, it's good. Means current assets minus current liabilities, you're having good amount in hand. It's good. If it is decreasing, that's not good. That's not a good point for that in the organization. Now, moving forward, if you see in here, current ratio is nothing but current assets by current liability, which I just said. You remember this current assets. Current assets is most of the times the numerator, and current liability is the denominator in which this current ratio. Then comes another one, which is quick assets. Quick asset ratio, or you can also call it acid test ratio. Now, what do we need to do in here is nothing but from this current assets, we need to remove inventory. What do we need to remove? Inventory we need to remove. Why do we need to remove inventory? Is because inventory will take time to be sold in the market, to be converted into cash. It will take time. Understand this. If you take any stock, or if you are selling any good or something, it will take time to be sold in the market and to be converted into cash. So that cannot be your quick asset. So what you need to do is nothing but your quick asset divided by current liabilities only. You need to do in here, like divided by current liabilities. So in fact, the CA minus inventories is nothing but called your quick assets. So quick assets by current liabilities is what ratio which you need to take out. So you can see in here, cash plus marketable securities plus net receivable. So what you're removing is inventories you are removing. So the same thing which I've just showed it here is the same thing in here. Same here also, your acid test ratio is also should be in an increasing format from previous years. If it is in decreasing format, that's not good for the organization. It should be in increasing form only. That would be much better. Then comes another ratio, which is cash ratio. So in cash ratio, it's understood. You take cash and marketable securities, which can be convertible into cash like this. Within some time you can do it. It should not take more than some time. In some time, you can say 2 to 3 days. A marketable security is becoming cash. It may take from your demat account to come into your cash account, or unfreezing it in your account. It should take 1 or 2 days or 2 working days. That can be termed as cash. So how much cash you are having with respect to your current liabilities. So that's what it is. Now understand this. Most of the times it sometimes becomes less than 1 or something like that, but still it's fine until unless it is in an increasing form. It is good for the organization. If it is less than that, then it is not good for the organization at large. Then comes your cash flow ratio. Now understand this. Here also you are having current liabilities as denominator, and you are taking cash flow from operations. Now cash flow from operations, accounting, that's from the accounting side, accounting for cash flow, which we do. We take all the cash flows from the operations and divided by the current liabilities to get our ratio related to how much is our cash flow from operations. And then comes is your net working capital ratio. If you remember net working capital, we just did it a little bit earlier before to this current ratio. There, net working capital was CA minus CL. What it was? Current assets minus current liabilities. Now what we have to do? Current assets minus current liabilities divided by total assets. We don't take current liabilities here. We take the total assets, understanding that how much is the difference which you are having in hand when compared to the assets which you have in your hand. I hope you guys are getting it. So now next we have to move towards the solvency. So liquidity is done. We go towards solvency. Now, how much is your solvency is depending on what is your actual capital structure. Now, when I talk about capital structure, most of the times capital structure I talk about is talking that how much debt do you have? Okay. How much debt do you have? How much equity you have? What exactly it is? How much debt you have? How much equity you have? It's a big time concern. Most of the organizations will have huge debt, huge equity, or they may have it in balance. If you have to take my point of view, my personal point of view, I would recommend more of equity and the least of debt. But there are other school of thoughts also which say that you should have enough of debt and enough of equity, and you should have it in balance. Now, when you have that in balance with debt, you do not lose out your controlling power. With equity, you may lose out controlling power. That's possible. With debt, you do not have to pay when there is huge profits, whatever is the amount, you have to just pay that amount. But the problem is, even if you have loss, then also you have to pay that amount. Whereas in equity, you get profit, you pay that amount, you get loss, you don't pay that amount. Okay, so let's just go towards the debt ratio calculation or solvency ratio calculation, that how solvent is your organization on books. So the first which is coming in here, like capital structure ratios, if you just see in here, total debt to total capital, how much is your total debt with the capital which you're having. Suppose you have a total capital authorized, not authorized, suppose you have total capital which you have taken from the market. As an organization, you needed 1 million rupees, you have taken 1 million from the market. Now how much you have taken in the form of debt is the question. How much in the form of debt you have taken? So most of the times it is suggested that debt should be less. Even if I'm going to talk about it, debt should be less, because whether you get profit or loss, you have to pay that amount. Debt should be less. Equity should be more, school of thought. But at some organizations, debt is more than equity. So that's also possible. Let's just go on in it in a more proper format. Total debt by total equity. See the ratios itself which we have to calculate. Total debt to total capital ratio, it goes with the question itself, total debt divided by total capital, nothing else. Then debt to equity. Debt to equity is nothing but total debt divided by stockholders equity. Now how much is that percentage? Like suppose, understand this, suppose you needed 1 million. Okay, 1 million is needed. Okay, 1 million is needed from the market. You have taken 300,000 in debt, 700,000 you have taken in equity. Okay, this is debt, this is equity. So what you do is nothing but you apply ratios in here. Now what ratio you are applying? Debt to equity. How much is the percentage of debt when compared towards equity? And that's there in front of you. They have taken these examples and solved it. I'm not solving it because this is a revision session. I hope that you guys have already done it. Even though we are going to do some MCQ questions, you are not going to get just like these direct questions in your examinations. If you get so, then you are very lucky for that. At times you may get it, at times you may not get it, but I'll prepare you for the worst, which is nothing but for the most difficult paper. We will be doing the GLIME MCQ questions. The GLIME MCQ questions are like, way about the standard of the examination, way more difficult than the main examination. If you are able to solve the GLIME question text bank and you get 90 above or 80 above in the GLIME material, then you are going to score huge marks in the main examination. I feel so you will be able to do that. Okay, so now then comes long-term debt to equity, which is nothing but long-term debt divided by, again, stockholders equity. Then comes debt to total assets. So it's nothing but debt to your complete assets which you're having. See, suppose you're having an assets of 2 million is your assets and your debt is 300,000. So you just come up with, okay, how much is that equivalent? Is it surfacing K? Is debt less than all these amounts? Then it is fine. But if debt is more than all these amounts, then that's a big time problem for the organization. And that's what analysis which you need to do, that debt should be less. Debt should be less only in organizations. Okay, now earnings coverage. Now earnings coverage, you need to understand this in here, that earnings before interest and tax, or you can call it operating income divided by your interest expense. Now what does it say is nothing but how many times can you cover, how many times can you cover your interest expense? How many times your income, how many times your income can cover your interest expense? That's what you calculate here. That's why in this particular problem, if you just see in here, they have written times. These many times it can cover. Previously, you see there's no times, or there's just a ratio, 1 point or 0 point something. But here it is how many times you're able to do it. Like earnings to fixed charges ratio, earnings divided by fixed charges, how many times you're able to cover these fixed charges? Again, here comes time. How many times, not time, not time. How many times you're able to cover it? Like suppose your interest expense is 10,000, your earnings before interest and tax is 100,000. So you can cover 10 times of your interest expense. That much income you're having. It's a good it's a good thing. If it is less times, then it's not that good, because you're not, after covering your interest expense, you're left over with very less amount. How are you going to pay the tax? How are you going to pay yourself profits? It's a big time problem for you. Not only yourself profits, you also have the equity shareholders to whom you need to pay profits. Okay. Then comes leverage. Now leverage, again, we have few ratios in here. If you can see in here, we have this operating leverage, financial leverage. Now operating leverage, financial leverage, you can understand it in a much better format in here. If you just see in here, operating leverage and financial leverage, let me just open up the income statement in front of you. I'll just draw the income statement. Like this is sales minus variable cost will give me contribution. You guys need to remember this all time. From contribution, I'll remove my fixed cost. I'll get what? My operating profit, or you can call it EBIT, or profit before interest and tax. Then after this, I'll minus my interest. Okay. And I'll get what? Earnings before tax. Now, till here, I'm going to show it to you. Your operating leverage will change. Your earnings before interest and tax will change based depending on this particular interest. That's your financial leverage. Sorry. Your financial leverage will change based on these interest amount. This is the place where your changes will be there. And your operating leverage will be somewhere here, like your contribution. These are the factors which will affect your operating leverage. So I hope you guys are understanding the difference between the two. Financial leverage will be determining towards how much funds you're having, how much interest you have to pay, and all stuff. Whereas operating leverage, how much sales you're having, how much is the contribution which you're getting. That's what they will be looking out for. I hope you guys are able to understand me in a clear format. So if you just see in here, degree of leverage, this is including all. Okay. Pre-fixed cost income amount, post-fixed cost income amount. So how much you're having previous to this, how much you're having previous to this, how much you're having after that. That's with the degree of operating leverage. If you just see in here, as I just said you, this one plays a major role. That how much is your income after fixed cost, how much is your income before fixed cost. That's what the fixed cost key. You have to find out how much is the dependency on the fixed cost. And if you just have to do it for a single period, it's nothing but your contribution margin divided by your earnings before interest and tax, which is nothing but this, your contribution margin divided by your earnings before interest and tax. What is the difference between the two? Fixed cost is the difference. Okay, I hope you guys are getting clarity in there. Then if you just see in here, there's another version of degree of operating leverage, in which what you do is nothing but you take percentage of change in operating income, or EBIT. Percentage of change in operating income, or EBIT, divided by percentage of change in sales. And for that, you need to take the previous year's amounts also, so that you can get the percentage of change. See, this particular percentage is percentage here. This triangle here means how much is the change. That's change in operating income, change in sales. That's what you're doing. And based on that, you are calculating your degree of operating leverage, and also percentage of change and degree of operating leverage. Yeah, percentage of change and degree of operating leverage. That's what it is. Okay. Now, next comes degree of financial leverage. Now, degree of financial leverage, as I said you, what is the main factor in degree of financial leverage? Where is my mouse? Okay, here it goes. Who's the main factor here? Who's the main factor? Interest is the main factor in degree of financial leverage. Interest is the main factor. You guys can put down your views in the chat section or the comment section, that are you able to understand it or not? Are you following up with me or not? Put it down in the comment section below, or the chat section beside, if you're watching this live. So if you just see in here what it is, interest is the main factor here. Now, when interest is the main factor, you just see EBIT divided by earnings before tax. Now, that's for a single period. Now, when we have to do the second version of it, what it would be? Degree of change, percentage of change in net income. Net income is nothing but your Earnings before tax is your net income. This is earnings before interest and tax is your operating income. Your contribution is your gross income. Okay. Then percentage of change in net income divided by percentage of change in EBIT. That's what you would be doing. So to find out what your degree of financial leverage change, or change of percentage change in degree of financial leverage, that's what you would be doing. Okay, now here we are done with what all we have done. We have done with the liquidity ratios, we've done with liquidity ratios, solvency ratios, and these gearings also we have been done. Now what we have to do is nothing, move towards the next chapter. So up till now, if you guys have understood, put down that yes, done, chapter 1 understood. Anyhow, we are going to do the MCQ sessions, but for now I hope you guys have understood. Let's move on towards the next chapter. Anyhow, it's going to be in this particular long session itself. You can take a break if you want in between and then resume back again, but make sure that you complete it for sure. Okay, so I hope that you guys have taken up a break and we get started with the next chapter. See, it is the same section itself, but they're just broken down into chapters. If you are doing it on, if you're using any other material, then it matters that how you are actually, going to put it down as per the sections. Let me just, full screen it so that you guys will be able to view it in a more proper format, and it's a bit big in front of you. And if I have to write something, I'll write it on this material itself, so that you can watch this material properly. The best material, which I would say, is the GLIME material. You need to get a GLIME material. This will help you pass the examination. Okay, so now next comes is the profitability ratio. See, what all ratios which we did just now is nothing but we did the liquidity ratios, we did the solvency ratio, we did the gearing ratios. Now we are towards the profitability ratios. Now in the profitability ratios, most of the times we'll be taking up the income statement, we'll be taking up, so that we understand that how much is the profitability. See, as I just, okay, this requires what we were just looking at. See, this is what we were doing, right? This sales and stuff. Okay, now when these sales and stuff which we are doing, understand this. Okay, 1 minute. Where is this? Okay, just bear with me here. You see, gross profit margin ratio, how do we calculate is net sales minus cost of goods sold. What it is nothing but your contribution only. Your contribution divided by your net sales. Your contribution divided by your net sales gives you what? Gross profit. And if you just gross profit ratio, if you just multiply it with 100, you get it in percentage amount. In margin ratio, you just get it contribution divided by sales, or your cost. You just remove your cost. You just remove your cost of goods sold from your sales, and you just divide that amount by your sales. Then comes your operating profit. Now operating profit margin is nothing but, again, if you just see in here, operating profit is EBIT divided by your sales. Your EBIT divided by your sales will be giving you your net profit margin. Now, sorry, operating profit margin. Now what would be your EBT, which is not, sorry, your net profit margin? If you just see in here, your net profit margin is going to be your earnings before tax divided by sales. There, what it has given, your net income divided by your sales. Your net income divided by sales, or your EBT divided by your sales. You do it, it's almost one and the same. Okay, so how you're doing it, you just see in here. See, they have also given it in such a good format. See, gross profit, operating profit, net income. Whatever is the amount, that amount you're taking it and dividing it by your sales, and you get your margins out there. Your gross margin is 19.4. Your operating income margin is 10.6. So if you have a calculator, just pause this session, do it as your practice. We will be doing these questions in the MCQ sessions. Okay. Now, moving forward, you have your earnings before interest, tax, depreciation, and amortization. Now, understand this. If you just see in here, these are some amounts which are taken into consideration, like these are fixed amounts. And amortization and depreciation is non-cash amounts also. Interest, taxes, sometimes, not sometimes, most of the time it is cash amounts only, but you'll be paying it at a later date, not on the day as and when you receive it. Just remove all this and see how much is your income. Just remove your interest, tax. Now I'm not talking about removing it, means deducting it from the earnings. Okay, you are doing it before even you are deducting this. Just remove it from the concern, just remove it from the calculation. Just take your earnings before interest, before taxes, before depreciation, before amortization, and divide it by the net sales. You would be getting your EBIT DA margin. In fact, this is the most used margin ratio in understanding the share value of the organization. Okay, then comes your profitability ratios. Let me just full screen it so that you guys will be able to look at it more properly, and let me just zoom into it so that also you can see it properly. Then comes your profitability ratios, where you're doing return on assets. Now when we are doing return on assets, what is your return? Net income. From what you have to get it is nothing but your average total assets. How do you get your average total assets? Your previous year assets plus your this year assets divided by 2. Your opening asset value, your closing asset value, divided it by 2. You get your average total assets, and that is to be divided by net income. The net income is nothing but your earnings before tax, after deducting interest. Net income by average total assets. Your return on assets, you've got it. Then comes your return of equity. Same, net income divided by average total equity. Net income divided by average total equity. Then you see in here, the relationship between return on equity and return on assets can be seen by the formula ROA is equals to return on equity multiplied by 1 minus debt ratio. That's a different story itself. That's just a summarization of it. Now let's move forward. Sustainable growth rate is nothing but ROE into 1 minus dividend payout ratio. Now this is nothing but how much you are paying out your dividend, and after that also how much you are growing in your earnings, how much you require as a sustainable growth. That's what it is said. Now we have come towards one interesting topic, which is nothing but DuPont model of the return on assets. Now what happens in here is that you take net income divided by average total assets is equals to net income by net sales into net sales divided by average total assets. क्या हो रहा है यहाँ पे? If you just see in here, net net sales यहाँ पे, ये net income, ये net income, क्या करके, sorry, what are they doing actually in this? It's a bit confusion. In fact, what it is nothing but they are just, in fact, yeah, if I have to just say it, what are they doing is nothing but, in fact, I use this term most of the times, and some person who was watching my video, he just said that with this comment only, he just commented again and again. I don't know what was the reason he wanted to do it. He wanted to point out that I am repeating this term most of the times. Yes, I do it. Net income divided by average total assets. So net income, what you're doing is nothing but again separating it. Average total assets, again you're breaking it down. Now what you're doing with breaking it down, if you just see here, net income by net sales you're doing, multiplied by net sales by average total assets. This is nothing but your net profit margin, which we just calculated it. Then your total asset turnover is net sales divided by average total assets. If you just see here, your net income is here and your average total assets is here. You can directly divide it, these two, and get your normal return on assets which you want, but you're taking your net sales into picture so that you get a more proper understanding about it. That's the only reason, more proper understanding that how much sales is affecting it. That's it, nothing else. Then we have this DuPont model on ROE, return on equity. Again, net income by net sales is your return on equity, but what you're doing is not, sorry, net income by net sales is not your return on equity. What you're doing here, return on equity is nothing but net income by average equity. But here what you're doing is nothing but splitting it again. You're splitting this formula. What you're taking, your net income, you're taking divided by sales. then your net sales divided by average total assets, then average total assets divided by average total equity. The direct what you could have done is net income divided by average total equity would have given you a return on equity. But what you have done, you have taken sales into picture. You have also taken your average total sales, average total assets also into the picture, so that you get more proper understanding of it, so that you can give more proper analysis about this particular ratio. Now, is this used in organizations? Yes, it is used in organizations. You will be required to split this up, have an explanation about what is the effect of net sales and this average total assets making on this particular return on equity, because it's not just, you know, your net income and your equity, it's not directly related, though you can summarize and give a formula answer for it, but it is highly dependent on how much sales you are having, and your sales is dependent on how much total assets you are having, how much resources you are having, so that you can generate those number of sales. I hope you guys are able to get it. I'm enjoying it, explaining it to you. I hope that you are learning also from it. Now, DuPont model for return on equity, they're just putting in an example. We would be, anyhow doing the MCQ session. So we'll be doing that. There are some inconsistent definitions about it. So it goes on, but what we've done is fine. But you see in here, under various return ratios. In fact, what I'll do is I'll just pause. You guys can just pause this. Okay. You guys can just pause it, read it by yourself, and then move ahead. Okay. Because I've got this issue also, students saying, okay, reading and all, anybody can do it. So just do it. I hope you would have paused it and done it. Now, moving forward, factors that are affecting reported profitability. Now, the income is a big factor which will affect. Now, they have said it. What all other factors in here? Your revenue is a big factor. Your revenue relationships, your expenses, including cost of sales. These all are really important, which affect the profitability. Oh, now income. Now, your income, is it earned or is it going to be earned? How is it, reported in your organization? If it is going to be earned, then that's not actual profits, though you calculate it as profit, but that's not your profit. So what do you do when you're calculating all these analysis and all? Just see what is the actual income earned. If you just see in here, your estimates should be right. Your revenue, how is the revenue flowing in? How is it giving an enhancement towards all these assets of the organization, or is it just coming in, is going to come in kind of a stuff? If it is going to come in, revenue is coming, is collectible, that's not good for the business at all. Not good for the business. I hope you guys are understanding with me. I can say it with a lot of experience also, that income which is receivable, recorded receivable, is a big time problem for the organization, because it is receivable. Don't know when it is going to be receivable, how it is going to be receivable, what all efforts you have to put in to make it receivable. In fact, even after you receive it, there is some other thing which comes: warranty, guarantee. If suppose those things happen, what you have to do? Return of sales. If those return of sales is happening, you already recognized it as a revenue. How are you going to reverse it? All these stuff are there in it. So these factors will affect the profitability of the organization. Suppose you sold you sold a particular product, good profit, going on well, recorded it, done. Investors saw that, or a good profit has happened. Now, one day, the customer is telling that we want to return it. How are you going to do it? That will affect your profitability. See, that recognition principles only, which we were talking about: realized, realizable, earned. So what you need to do is follow this 5-step model. Identify the contract with the customer, identify the performance obligations. If the performance obligation is done, then you need to recognize it. But before that, you see the transaction price, that allocate the transaction price to the performance obligation in the contract, and then only recognize the revenue. Until then, don't recognize it as a revenue. That's what they're saying. Until performance is done, don't recognize it as a revenue. There are organizations like these who do not recognize. Like, suppose you sell something on, I have this bottle, I sell it on Amazon. What happens next? Amazon, suppose I don't know whether they have this policy or not. You can return this particular product within 14 days, no questions asked. So until 14 days, I cannot recognize it as a revenue, because there are chances that he may call for a refund. And if he calls for a refund, I have to. Next, I guess these are the stuff which you guys can go ahead, read it. Cost of goods sold divided by gross profit margin. Okay, moving forward, major categories of expenses for a company. This is something which you guys can read it. These are selling, general, administrative expenses, income tax expenses of the organizations. Now, trends in expenses. This is something which you need to understand in the organization, that how is the expenses? Is it increasing? Is it decreasing? Or all of a sudden there is one expense which has come out of nowhere? Because there are chances that these expenses may trigger your financial statement analysis. And if suppose they may not give a proper financial statement analysis, then it is a problem for the organization at large, and also for the stakeholders who are going to make decisions about this organization. Okay. Then effects of the accounting changes. If there's a change in accounting, why do we actually change an accounting principle or accounting policy which we are following? Number one, it gives a better presentation of the financial statements, more true and fair view of the financial statements. Number two, it is required by the law. It is required by the law that you have to change it. Or if suppose the organization is changing itself their own or if suppose it is giving errors and you have to be consistent and remove all those errors, you just change your accounting policy. Like suppose you are changing it from suppose you are following depreciation, you're following the WDV method, which is the written down value method. You change it towards a straight line method, or straight line method, you change it to WDV. You should give proper explanation about it. Then whenever you're going to change it, how are you going to affect it? Are you going to affect it from the day the change has happened? Then it is called prospective effect. Means from the past 5 years, we used to follow in one method. Now we are going to change it. From now, the change is going to affect. That is a prospective effect. What if you are changing it today and you're telling that all the previous years, that is to also to be affected? Then what happens is you have to change all those also, and all those from the start date, and that's the retrospective effect. Whatever are the changes, you have to make it in the financial statements from now on. Okay, now that's again towards the accounting side, not the financial statements analysis side. Okay, then moving forward towards the per share ratios, very, very, very important. Now comes earning per share. Now for that, let me just go towards the income statement again. Now here, if you just see, I just made an income statement for you, though it is a little bit clumsy right now, but still follow it up. Sales minus variable cost has given you contribution, minus fixed cost has given you operating profit, minus interest has given you earnings before tax. Now what you will be doing after this earnings before tax, you will remove what? Your tax amount. You'll have earnings after tax. And now once you have your earnings after tax, what you'll do is nothing but you will remove what? Preference. You'll remove preference dividend. Now this is a minus preference dividend. Okay, once you minus preference dividend, you'll have earnings available for equity shareholders. Earnings available for equity shareholders. But what do? Do you actually give away all these earnings to the equity shareholders? No, you do not give it all to the equity shareholders. What you do is nothing but you minus some amount. What is that amount? You keep it as a safety. You keep it as a margin, or you can say it margin, or you call it reserve, or whatever you call it. You keep it aside, and then you declare for the dividend that this amount is available for dividend. Now understand this. The amount at which it is earnings available for equity shareholders. Earnings available for equity shareholders. At this point, this amount you divide it by the number of shareholders. At this point, you divide it by the number of shareholders. At this point, if you divide it by the number of shareholders, you will get earnings per share. But that does not mean that you're giving away that complete amount to the equity shareholder. What happens is next, you keep it as a reserve because you're not giving it away. Then you pay dividend. Now, whatever dividend you are paying, that you divided by the number of shareholders again. Number of shareholders, you do it. So what this happens to be is nothing but your dividend per share, because that is the amount of dividend per share you're giving. Now comes in, suppose you had earnings per share ratio of 100 and your dividend per share ratio is suppose 40, that means your reserve is 60 per share. How much is your dividend payout ratio? Is nothing but your dividend per share divided by your earnings per share. Means how much you earned, but how much you're giving it out. That matters a lot. How much you earned, but how much you're giving it out. So I hope you guys have understood how we have calculated earnings per share, how we have calculated dividend per share. And now let's move forward. Let's just go back towards the material and move forward over there. Now in here, if you just see, earnings per share is nothing but net income available to common shareholder divided by weighted average common shareholders outstanding. That's what it is, which we just calculated. Then what is there? Okay, they also made an income statement and did all that stuff. Okay, they also did weighted average, basic weighted average number of shares outstanding. Now, weighted average number of shares outstanding is also something which you guys need to do. For that, let me just open up again. Now, weighted average, to do this, you need to see that at what date you purchased, at what date you have issued those number of shares. Suppose you issued it at the start of the year, so you take it as a whole year. Suppose you issued it as the middle of the year, then you take that earnings of that complete means that portion only in which those shareholders were there, not at that portion in which those shareholders were not there. I hope that's clarity to you all. Then moving forward, if you just see in here, basics earning per share ratio, okay, that's fine. Effect of stock split. Okay, stock split is nothing but, suppose you're having an equity stock, you're just splitting it into two. So if suppose it is of $10 stock, you split it, it becomes $5 each. Suppose you have one stock, it becomes two and it becomes $5 each. That's the major difference in it, not much. Then comes diluted earnings per share. Now, diluted earnings per share is something which you guys need to understand in here. Now, what did we do in this income statement? What did we do is nothing but we had sales minus variable cost gave us contribution, minus fixed cost gave us operating income, minus interest gave us earnings before tax, minus tax gave us interest after tax, and then dividends. Preference dividend we minused, and then we got earnings per share. Then we kept a reserve, and then we had the dividends. Now, what is this diluted earnings per share? You would be having this question. Simple answer to it. Sometimes some equity shares or some loan notes or some debentures are convertible towards equity. Suppose, what do you pay towards loan notes or debentures? You pay you pay them interest. What do you pay them? You pay them interest. Suppose those loan notes or debentures are converted towards equity. Now, when they're converted towards equity, what happens is your interest expense will go down because they have been removed from the loan. Your interest expense will come down. So what will happen? Your earnings available to equity shareholders will increase. With that increase, your number of shares will also increase. Your number of shares will also increase. Now, when you calculate it again for the next time after that conversion which has happened, then there will be a change in earnings per share. And that change in earnings per share is your diluted earnings per share. Now, it's not only just because of this conversion. There are sometimes you may sell it off or some other stuff is happening. Then also there is a diluted earnings per share. So it's nothing but you just calculate it again and then you get a DEPS. That's diluted earnings per share. Now, moving back towards, see, they did not give any formulas also for it. They just said it, and what I've said it, that's what it is. Now, price divided by earnings before interest, tax, depreciation, and amortization. So market price per share divided by earnings before interest, depreciation, and amortization. You would get that amount. Price by EBITDA, they call it EBITDA ratio. You get that. Okay. So what are the advantages of EBITDA? I've just said it to you. It is used in share prices of the organization so that all those non-cash expenses and all, they are not taken into consideration. Okay. Then book value per share is nothing but total stockholders equity minus preferred equity divided by number of equity shareholders. So it's nothing but your earnings before interest, earnings available for equity shareholders divided by the number of common shares outstanding. That's it. Then comes your price earnings ratio. Now, price earnings ratio is nothing but your market price divided by your earnings per share. So it's nothing but what is the market value of that share? Suppose the market value of that share is 1000. What is the earning per share? It is 100. So how much is the price earnings ratio out of that amount which you have invested? So that's your income order. See here, it is said EPS, not DPS. DPS is something which is actual cash which you receive. EPS is not that actual cash which you receive. I hope you guys are getting it, the difference between the two. Then comes market to book value, market price per share divided by the book value per share. How much is it in the market? How much is it in the book? What is the difference happening here? That's how you calculate with that ratio. Then again, price sales ratio, market price per share divided by sales per share. You will have that price per sales ratio, but based on the market, how much is the sales, to have an analysis whether to invest here or not. Then other based is nothing but earning per share divided by market per share. Then there is dividend payout ratio, which I just said, dividends to common shareholders divided by income available for common shareholders, or you can also call it dividend per share divided by market price per share, how much you're yielding out. And also, which I just talked about, DPS divided by EPS, you get your dividend payout ratio also, EPS divided by DPS. Shareholder return, what is the ending stock price minus the beginning stock price plus annual dividends divided by the beginning stock price. This is nothing but your return from the start till now. What all are the changes which have happened and how much return you're going to get? That's what is your shareholder return. Now, coming up towards the next chapter. Next chapter we are talking about, but it's almost the same. If you guys are taking a break, take a break and then resume back again. Now, in this chapter, this is actually, they just split it up this chapter. Otherwise, it was part of the previous chapter itself. But still, what we are going to do is nothing but we are going to do the activity ratios and some special ratios and earnings quality we are going to talk about. So now in this activity ratios, again, we have to take the income statement and the balance sheet. In fact, the previous chapters which we had taken the example, the same thing is coming in here. What we are calculating is, see, activity when we talk about is nothing but how much sales we are making, how much purchases we are making, and then how much is the inventory in our hand, how much it is getting converted and how soon it is getting converted. So first we'll be doing how much is the receivable and in how many days we are going to receive our receivables. And then in how many days are we going to pay our payables, and how is that cash cycle going to go on? That's what we are going to do in here. So we have this as an example, income statement and balance sheet. Anyhow, we are going to do the MCQ question. So see your receivables. How much is your receivables? How much is the receivables turnover is nothing but your net credit sales divided by average accounts receivable. Your net credit sales divided by average accounts receivable, you get how much is your accounts receivable turnover. Now, with this account receivable turnover, what you do, first of all, what do you calculate is nothing but your account receivable turnover. With that account receivable turnover, you take it forward to days in a year divided by accounts receivable turnover to get how much. What is the days sales outstanding in receivables? How many days is it going to take from your sale to be converted into cash? That's what is a concern, right? It's not that how much sales are happening. After the sales which has happened, how many days is it going to take to received in cash? To be received in cash. Now, see in here. So what did we calculate first is nothing but net credit sales. So what we are taking, credit sales divided by your average account receivable. What is your average account receivable? Starting balance plus closing balance divided by 2. Net credit sales divided by average accounts receivable. Then with that account receivable turnover, what do you do is nothing but days sales outstanding in receivables. We find it out, and that's how we do it. Days in a year divided by accounts receivable turnover. I hope you guys are getting this understanding. Then you see you get this 23.9 days, 28.9. So whatever is the nearest amount, you just round it off. Most of the times you round it off only, but still if you're not able to round off, just put that amount in points only. Anyhow, in your CMA examination, you're not given a chance to explain that answer. You just have to take the nearest answer to it. In your essay section, you'll be required to write it down. That we'll be looking up further. Now then comes your inventory turnover ratio. Now, inventory turnover, how do we calculate? Is nothing but cost of goods sold divided by average inventory. What is average inventory? Opening inventory plus closing inventory divided by 2. And that is divided by nothing but your cost of goods sold, COGS divided by average inventory. Now, when we have found this out, this inventory turnover ratio, we take it forward and we do it days in a year divided by inventory turnover ratio, or inventory turnover, days in a year divided by inventory turnover, so that we understand how many days does it take for the inventory to stay in our warehouse and to be sold. How many days does it take for the inventory to stay in our warehouse and then after that to be sold? That's what we are calculating. See, it takes 17 days, it takes 15 days. These all are connected. What did we do first? Receivable days. Then we did inventory days. Then what we are going to do is nothing but your payable days. After that, when you calculate all these three in a proper circle, your receivable days plus your inventory days minus your payable days, it will become your cash cycle. Okay, nothing but your operating cycle, you can say. Now, payable days. Payable days, what you do is nothing but you take purchases, you divide it by average accounts payable. Sir, how am I going to remember this? You guys need to remember this relations between all these. See, in receivable days, you take net credit sales divided by average receivables. In inventory, what do you take? You take cost of goods sold divided by average inventory. They are related to each other. Then in payables, what you do? You take purchases divided by average accounts payable. That's what you are taking in here. Then whatever the average accounts payable turnover you receive, the accounts payable turnover you receive, you take it forward and divide it by, or the days in a year is divided by that amount or that answer to get your days of purchases in the payables, accounts payable. That how many days you're going to take. Ideally, what it is said is nothing but your inventory days should be less, your receivable days also should be less, your payable days should be more. Good for the organization, it said. But still, moving forward, what do we do is nothing but we take all these three ratios and make it into a operating cycle. Your collectible, your days in sales, your days in receivables, and then you minus your accounts payable, you get your operating cycle. Sorry, this is nothing but your operating cycle. Your how much was your current year, how much is the pre-year. Here we have not yet minus it from the accounts payable. That's how it takes your receivables, your stuff to be rolled out in the market, your inventory to be there in hand. That's your operating cycle. Moving forward, what you do is nothing but from your operating cycle, you remove the days of purchases or in the accounts payable. That becomes your cash cycle. See, you can see cash cycle is nothing but your amount of whatever was there previously. You minus all these stuff from it, which is nothing but your payable days. So done till now, what all did we do? Receivable days, inventory days, payable days. These three we did. Now comes is working capital turnover ratio. Working capital turnover ratio is nothing but, see, turnover is nothing but sales. Turnover is equals to sales. So sales divided by working capital. What is working capital? Current assets minus current liabilities. Video के start में कर रहे थे हम लोग. Session we did it at the start of the video. Now, then other activity concepts which we need to do is nothing but fixed asset turnover ratio, which is net sales by average net property plant. Not that specific to be done, but you guys can go through it. Asset turnover ratio is net sales divided by average total assets. It goes with the name itself. Okay. Then ratio analysis and earnings quality. So it's a bit of theoretical topic which you guys can go through it, that okay, why these analyses are done, what is understood from these analysis. This is what we'll be doing in this particular ratio analysis and earnings quality. So overall, you guys can go through it, understand what is economic profit and what is accounting profit, what is the difference between the two. You guys can understand it. The difference between the two is nothing but your accounting profit is your normal profit, which you calculate. In your economic profit, what you do is nothing but you also take consideration of the opportunity cost, the opportunity which is lost. That also you take it in the economic profit. Okay. So earnings quality is something which is important for you, is a measure of how useful reported earnings are as a performance indicator. If earnings have high degree of variability, many ratios will become less meaningful, because if the earning is going to fluctuate a lot, these ratios are not going to be useful. But if suppose it is not that fluctuating, then these ratios are highly relatable. Earnings power is a related concept. It is the capacity of firm's operation to produce cash inflows, etc. Okay, you guys can read this. Now we'll go towards the MCQ questions. I hope that this what we have done, this is complete section A. Complete section A, we have done it. We'll be doing the MCQ sessions and then moving forward. So let's just go towards the MCQ sessions. If you want to just take a short break, you can take a short break, pause this video, and then continue it. And we'll get started with the MCQs. So we'll get started with the MCQs now. All right. So what I've done here is I've just taken 10 questions of that particular topic. Let me just zoom in this particular thing. This is again the GLIME material, GLIME MCQ test bank, one of the best test banks. I would always suggest if anyone is doing it, this is the best thing to practice on. So here, let me just tell you that, see, we just did these concepts. You learned it in the start of this particular session itself. Now we are going to do the MCQ questions. If you would have just seen that we did not do the examples which were given in the textbook itself, we are going to do it here. So if you just see it in the textbook, if you just go back and see the examples in the textbook, it's just easy illustrations. It's just, what's this ratio, how do you calculate that ratio? That's just dumping of data. But here you just actually have to implement a lot of stuff. You need to apply a lot of thinking in here to get this done. Okay, so let's just get started with it in here. If you just see, whenever we are solving this question, make sure that you read the requirement first. D-Pool's payment of trade account payable of 64,500 will, okay, if he's making this payment, what is it going to affect? D-Pool's company is a manufacturer of industrial products that uses a calendar year for financial reporting purposes. Assume that total quick assets exceeded total current liabilities. Total quick assets exceeded total current liabilities both before and after the transaction described. Further, assume that D-Pool has positive profits during the year and a credit balance throughout the year in its retained earnings account. Okay, so it is having enough funds also in the account. So if he's going to make a payment of 64,500, what is going to be the effect? Option one is increase the quick ratio, but the current ratio would not be affected. Decrease both the current and quick ratios. Increase both the current and quick ratios. Increase the current ratio, but the quick ratio will not be affected. So let me just add up this in here. Let me just try doing this. Understand this. What did he say? He's making a payment of 64,500. And in the question, what did he say is it says that the quick assets exceeded the total current liability. So if the quick asset is having a positive amount which is more than one when compared towards current liabilities, then the current asset will also have current assets will also be more than one. So if I have to just see on this question, if he's going to make an account payable amount, so an account payable amount will be decreased. So your current liabilities is going to go down. And at that same amount, your numerator is also going to decrease because the cash amount is going to go out. So when comparatively, if the same amount is going out, let us just see in here. Suppose this is, let's just take our amount to be 200,000. Okay. 200,000 divided by, let's just take 100,000. Okay. Suppose this is what our ratio is. So, and we have to minus this 64,500. If you guys are having a calculator, I'm just doing it on my phone. I'll just calculate and see what it is. 200,000 minus 64,500. Okay, 135,500. Suppose this is quick ratio. Let us just see. And this is also 64,500 minus 100,000. This will give me 35,500. Okay, what is the ratio here and what is the ratio here? Here I guess it is 2 by 1. It's going to be 2. Now with this 135,500 divided by 35,500, it is 3 point something. 3 point something. So it is increasing. So now when it is increasing with current assets, so current quick assets also, it should increase. Let us just see if that option is there. Decrease both current and increase quick ratio, but will not be affected. Increase both current and quick ratios. This is an option there. Increase the current ratio, but the quick ratio would not be affected. I've just worn this glasses. If you just see, थोड़ा screen पे strain ज़्यादा हो गया था. I guess, yep, this is the answer. I hope that you guys are getting clarity over this in here. That increase both the current and quick ratios. It's been long. I need to wear this. Then the next question. During the year, Ali's officers exercise share options or for 1,000 shares of stock as an option for $8 per share. What was the effect of exercising the share options? Let's read the question. Wow, what is it talking about? The following information pertains to Ali Corporation. As of and for the year ended 31st December, liabilities is 60,000. Equity is 500,000. Your shares of common stock is 10,000 and your net income is 30,000. What will be the effect if 1,000 shares are issued and at $8 they are issued? So let me just see in here that what all things will be affected first. Okay, what all things are going to be affected in here? What all other things going to be affected? Let me just see and write it down here. So the 1,000 shares at $8, right? At $8 it will equal 8,000. Okay, so 8,000 will be the equity amount which is raising. Is the liability increasing? No, liabilities is not increasing. Number of shares stock issued and outstanding, this will also increase, but the net income is not going to change. So let us just see the option. Asset turnover. Asset is not at all in here, so asset turnover cannot be the answer. Debt to equity ratio decreased to 12%. Okay, this can be the option. Why? Because the debt to equity, so equity is raising, so automatically your debt to equity ratio will decrease. Earnings per share increased by 0.33. Earning per share, how can it increase? Why? Because the net income is going to be the same. Then the net income is going to be the same and the number of shareholders are going to increase by 1,000. How is it going to increase? In fact, it will decrease. No ratios were affected, kind of, but I would go with debt to equity ratio decreased by 12%. And yes, that is the answer. I hope you guys are able to understand it. And I would request you guys is that try answering this question by yourself first before I answer it. Pause it. You're able to see the question. Try answering it yourself. Look into that, how you are able to solve it, because you've done this particular session. Try doing it so that, or else suppose you've done the revision, you've watched the revision class, pause it there. Try doing it. Try learning it by yourself first and then come towards these MCQ questions. That's also advisable. Or else if you just want to learn it, understand it in this particular format, do it in this format also. Next, big question. Markham's current ratio would be, what it would be. Okay, let's see the options. Increased by the dividend declaration and unchanged by dividend payment. Unchanged by either the dividend declaration or the dividend payment. Unchanged by the dividend declaration and dividend payment. Decreased by dividend declaration and increased by dividend payment. So without reading this question, I have actually made up my answer. Why I've made up my answer? Because I've answered a lot of questions like these. Let me just explain this to you, is that when you are declaring a dividend, it means that you have raised the liability. When you have raised liability and you have made sure that, okay, at the time of declaration itself, that this is the amount to be paid. And when you actually pay it, then the liability gets decreased. Understand this. This is something for your learning itself. Okay, just see in here. Excerpts from the financial statement: cash, accounts receivable, inventories, total current assets, accounts payable, accrued liabilities, total current liabilities. Fine. The board of directors, Markham, met on May 5th and the current year declared the quarterly cash dividend in the amount of 800,000, $0.5 per share. The dividend was paid on May 28th of the current year to shareholders of record as of 15 May the current year. Assume that only transactions that affected markup during the May at the current year were dividends transaction and the closing entries have been made. So we have read the options. Let us just read it again. As I just said, you guys, as I just said, you guys, is that when you declare the dividend, you raise it as a liability. That yes, this is the liability to be made, and when you pay it, the liability decreases. So if you just see in here, what will happen to the current ratio? He's telling the current ratio will be decreased. Why? Because you are raising a liability, and once it is paid, the liability will decrease. So the current ratio will increase. So decreased by dividend declaration and increased by dividend payment. This is what is the option which I can go for without even reading the question. But still, I'm here to explain that to you. I hope that you guys are understanding that why there's a decrease in the dividend declaration. Why? Because at the time of declaration, you are raising it as a liability. And when you're making the payment, you are decreasing it. Your liability gets decreased. So, yep, that is the answer. If you want to read the explanation, you can pause it and read it. I'm moving forward. Now, North Bank is North is considering as a possible limitation of using ratio when I'm not able to understand anything here. North Bank is analyzing Bell Corp's financial statements for a possible extension of credit. Belle's quick ratio is significantly better than the industry average. Okay, which of the Belle's quick ratio is significantly better than industry average? Okay, which of the following factors should not consider as a possible limitation of using this ratio when evaluating Belle's credit worthiness? Which of the following factors should consider as a possible limitation? So if he does not want to extend his credit, if he wants to be more keen in looking into the financial statements, that what's wrong in it, what can be wrong in it, how should he evaluate the credit worthiness of Belle? So we can see in here, increasing market prices for Belle's inventory may adversely affect the ratio. I don't think so. It's making sense. Fluctuating market prices of short-term investment may adversely affect the ratio. Can be. Belle may need to liquidate its inventory to meet its long-term obligation. No. One second. Why is Belle may need to? Why the statement should come? Why? Because I'm North Bank, and I have to evaluate it. So Belle has to do nothing because I'm the third party to evaluate whether should I extend his credit or not. Why does Belle has to do anything? Belle may need to sell its available for sale investment to meet its current obligation. Why should Belle sell it off? I do not say I'm just a third party looking into the financial statements. And there is a possibility that if there is fluctuating market prices of short-term investments, it may adversely affect the ratio. And I think so this should be the answer. Yes, it is. I hope you guys are following up with me and understanding all these stuff which I am explaining it to you. You guys, if you're watching it till here, make sure that you share this video. You have to share this video with maximum students out there who are doing CMA. Go out there, tell it to them. This is something which I'm doing it for you guys who are going to give their examination soon for the CMA US. This is part 2. Sooner complete part 2 will be there in the next six sections. 6 sections are there in part 1, part 2. 6 videos of part 1, 6 videos of part 2. You have it all. What you need to do is share this. I'm doing this for you guys. You need to share this. Okay. Next, an entity has total assets of 7.5 million and a current ratio of 2.3 times before purchasing 750,000 of merchandise on credit for resale. After this purchase, the current ratio will be lower than 2.3 times, be higher than 2.3 times, be exactly 2.53 times, remain at 2.3 times. So let me just open this up. What is happening here? Let me just, okay. let me just take in here. Entity has total assets of 7.5 million. Okay, that is fine. Current ratio is 2.3 times, and before purchasing 750,000 of merchandise. So 2.3 is my current ratio. It means that, suppose let me just take it. Let me take my current liabilities as 1 million, for example. So my current assets will be 2.3, क्योंकि 2.3 का ratio, because 2.3 ratio I have it. Suppose this ratio is actually before purchasing. Okay, suppose I'm purchasing this. What happens here is I'm purchasing it for resale. So my current assets will increase by 750,000, and I'm purchasing it on credit, so my cash is not going out. So 750,000 plus 2.3 million, how much is it? How much is 2.3 million plus 750,000? It equals 3.05 million. Okay, 3050 divided by, and my current liability will increase because that's payable for me. So 750,000. Now, what is the ratio if I divide the two? Divided by 175. 1.72. 1.742. So how much is it? 2.3 it was previously. Now it is 1.74. It is lower than 2.3. Clear? Make examples in the examination. You need to do it. Do this calculation, which I just did it. You will be having a scratch paper in front of you in which you can do the scribbling and answer it. Do that. Okay. A company located in China has reported its first quarter. What do we need to find out? What is the forecasted quick ratio for the second quarter? Forecasted quick ratio we have to find out. Easy, right? A company is located in China has reported in its first quarter balance of 100,000 cash, 200,000 accounts receivable, part of quick ratio, 90,000 as current liability. So what we can do, 100,000 plus 200,000 divided by 90,000, we can do it, and quick ratio will be there. Okay, 1 second. The controller has forecasted that during the second quarter, there will be no change in accounts receivable, but cash balances will increase by 5% and current liabilities will decrease by 10% based on the controller's forecast. What is the quick ratio? Second quarter. So what we need to do again, calculate it. So if you just see in here, accounts receivable, he said that it is not going to change, but what is going to change? Cash is going to increase by 5%. So it is going to be 105,000. And my current liabilities are going to decrease by 10%. So 90,000 minus 10% is 81,000. And what is my account receivable is my 200,000. So it is 305,000 divided by 81,000. 305,000 divided by 81,000. 3.76. 3.76. 3.77. Go ahead. Make sure that you calculate, guys. Simple questions. See, we're just going to make a short mistake here. Don't do that. Now, what is company's net working capital? I hope you guys are able to look at this. What is the company's net working capital? What is net working capital? Current assets minus current liabilities. So what all are my current assets? Cash is my current asset. Yes, 160,000. I'm calculating it here. 160,000 I'm taking. Equipment 50,000 is my non-current asset, so I'm not going to take it. Inventory 35,000, I'll take it. Then account receivable 160,000 plus 35,000 plus 25,000 account receivable. Then accrued wages is 10,000. Long-term debt, I'm not going to take it because that's long-term. Accounts payable is 5,000. I'll take it. So minus 15,000. Minus 15,000. How much is my net current net working capital? 365,000. Sorry, what did I do here? Did I do something wrong? Maybe in the calculations I did something wrong. Cash is 160,000 plus 35,000 plus 25,000. 25,000 is equals to 220,000. Yeah. Minus 15,000, 205,000. Calculation mistake. Silly mistakes. Need to cross check calculations again and again. Guys, you guys need to do it. Your exam is approaching soon. I qualified it few years ago. Next. Again, working capital at year end is he's calculating. So what should I take? Current assets, what should I take? 10,000 cash. End of the year he's telling, so I'll just take end of the year values. 20,000, 8,000, 30,000. Available for sale securities. Available for sale securities it has given. It means that it is available for sale in this year. Historical cost is given. Fair value amount is also given. So you have to take fair value amount only. Then accounts payable 15,000 I'll take. Notes payable in 90 days 25,000 I'll take. Bonds payable in 10 years I'll not take. Net credit sales, net cost of goods sold does not matter. So cash here is 10,000 plus ending year balance 20,000 plus prepaid expenses 8,000 plus what's there next? 30,000 end of the year. Inventory I've taken. The next what I have to take? Fair value at the year end 12,000. So 80,000 are my current assets. Current liabilities is 15,000 and 25,000. So minus 40,000. Is 40,000 there? Yep. So here, that's how we do it. I hope you guys are able to follow up. Share this video. Share this video. I'm doing this for you guys. I'm going to put in all revision classes so that you guys qualify this exam. Okay, next. What was company XYZ's net working capital? Again, net working capital they're asking. Again, so no problem. We'll do this net working capital. We'll do it real quick. Cash 110 plus account receivable 280 plus inventories is 175. 110 plus 280 plus 175 is inventory plus prepaid expenses 20. Then plant property equipment, I don't need it. And then accounts payable 208,000. Notes payable 150,000 because it has not mentioned with this that what do you call, whether it is short or long. Then accrued expenses 50. Yes. Deferred taxes, I don't need to take. Deferred taxes means you do not have to pay it this year, you have to pay it next year. Minus 208 minus 150 minus 50 is equals to 177. Yep, it is right. If you want to see the explanation, you can pause it and see it. Next. Okay, quick acid test ratio. Pretty easy one, good one. Accounts receivable, do we need to take in acid test ratio? Yes, we need to take. Accounts payable, do we need to take? Yes, we need to take. Bonds payable in 10 years, do we need to take? No, we do not have to take. Cash, we have to take. Yes. Interest payable in 3 months. Yes, we have to take. Inventory, do we have to take an acid test ratio? No, we do not have to take. Land, do we have to take? No. Note payable in 6 months. Yes, we have to take. And prepaid expenses, do we have to take? No, we do not have to take it. It comes under current assets, but not under the quick test. Okay. So let me just, put it down in here. So accounts receivable 200,000 plus cash 100,000 and inventory. I do not have to take nothing else. I think so. Next is my accounts payable 80,000 Then this interest payable in 3 months 10,000, so 90,000 up till now, plus notes payable is 50,000. 90,000 plus 50,000, 140,000 divided by 140,000. 2.14 is 2.14 there. Hopefully we are, yes, we are right. We are right. I'm doing it on my calculator. I want you guys to do it. I'm dictating what all things I'm doing in here. So, yep, we have come towards the end of this session. I hope that you guys have understood a lot from this particular session. I hope that you guys have learned this complete section A of CMA part 2. Very easy session, very easy section also. I hope you guys get maximum marks out of it. Just understand this, these are silly questions in which you can make mistakes. Try avoiding it and get maximum marks from it. And now I'll see you guys in the next session, in which again I'll be taking another section and solving this completely. If you have watched this particular session till here, share this video, subscribe to our channel, and also try sharing it with almost all people who are going to get benefit. Thank you very much for watching.